Hi, in this video, we'll understand various types of banks. Then we'll understand regulatory landscape which is applicable to banking organizations. And we'll talk a bit about the capital requirements because capital happens to be an important component whenever it comes to overall risk management for a banking enterprise. So we'll talk a bit about the capital framework. These are the learning outcomes which are expected as a part of this reading. So let's introduce ourselves to the concept of banks. So most of us are familiar with what a bank is. So the main purpose of the bank is to meet the banking requirements of the broader market. So as we know, the core business of a bank is to borrow money from customers and lend it to businesses or entrepreneurs who require it for various industrial or entrepreneurial or business activities. And in this, the bank is going to earn a margin. That is what we call as a net interest income. So bank is going to pay a certain amount of interest on the deposit which it receives from customers, and subsequently it is going to charge the borrowers, that is the businesses who borrow funds from the bank, and they are going to receive a certain amount of interest on them. And the difference between these two interests, that is the interest on the borrowed funds and the interest received from the lent funds, that is the net interest margin which a bank is going to earn. And this happens to be the core business for the bank. Along with that, there are various other areas which banks work on. So we'll talk a bit about investment banking, merchant banking activities, etc. Then a simple classification of banks is commercial and investment banks. Now, commercial banks can be subdivided into two entities. One is retail banks. So retail branch offices are there to meet the requirements for individuals, small businesses, etc. Whereas we have wholesale banks, which are there to meet certain larger requirements. Because whenever we have larger clients like institutional customers or even corporates, their funding requirements are bigger. So these are classified as wholesale banks. So again, common terminologies which you will come across whenever you study ALM frameworks in banks. So as a part of the liquidity risk management, which we study in ALM, we have we have balances from both retail banks as well as wholesale deposits, which are taken into consideration. That is what we call as retail deposits and wholesale deposits, something which gets used in various liquidity requirements calculations. So again, this is how we can relate these subcategories of banks to how exactly we manage the liquidity scenario for a bank. So we'll talk a bit about liquidity as well as a part of this discussion. Then coming to investment banks. So investment banks are that section of the bank which helps in a set of activities, including raising of capital for companies, providing advisory services around M&A, corporate finance, etc. Further, activities like IPOs, which we call as a primary offering, or even a secondary offering which a company might want to do. Now, iBanks are there to assist various companies to do that. Now, post 2008, there was a distinction which was made between the activities of commercial and investment banking. Because up to the build-up of 2008, what had happened was banks had, to a significant extent, combined commercial and investment banking activities. That is, even the savings which were parked with the bank could use it for various investment banking or trading activities. So, post the 2008 debacle, various guidelines had come in whereby banks had to have a Chinese wall separating the commercial banking and the investment banking activities. That is, we want to, the main idea which regulators were trying to convey was we want to protect customers' money. That is, we do not expect banks to invest customer deposits for their proprietary trading activities. So that was a clear message which was sent by regulators, and a few guidelines had come around this time. So ring fencing was one of the popular guidelines. So ring fencing, along with that, we have additional guidelines in the United States as well. So these are the activity, or these are the guidelines which will set a clear-cut rule which banks are expected to follow. And the main idea is to bolster the overall customer confidence, because the customer should know that the money which they have parked with banks is safe and that will not be used for any risky activities. So risky activities can include any risky lendings or tradings or any kind of investment banking activities particularly. Now, talking about a few types of risks which banks face. So here we focus on three types of risks: credit risk, market risk, and operational risk. Along with that, you have other couple of sources of risk which you call as legal, reputational risk, etc. But credit, market, and ops risk, these happen to be more of quantitative in nature and something which we study as a part of financial risk. Whereas other types of risks like legal, reputation, etc., that is more on the legal or the compliance side of things. Again, they are also equally important risks, but that is not something which we'll spend too much time as a part of this discussion because we don't expect that to appear on the FRM Part 1 examination. The focus will be on the first three types of risks. So let's try to understand what these risks are. So starting with credit risk. So from a banking perspective, credit risk happens to be the largest component of risk which a bank is exposed to. And that is primarily because of the model which a bank operates on. So as we discussed at the outset, the main business of the bank is borrowing money from customers and lending it to businesses. Now, whenever a bank is lending out money to customers, it is taking a certain risk on the customers, isn't it? Because there is a chance that the borrower might default. So the default can either be partial or it can be a complete default. But in either case, the bank is going to be exposed to a certain loss of funds because if the borrower defaults, naturally that will result in a certain portion of funds which won't be recoverable. So risk of default is something which we study under credit risk. Along with risk of default, other things which we can possibly add to is something which we call as a credit downgrade risk. So a downgrade risk implies the risk whereby the rating or a credit rating for a certain entity or a certain borrower drops. That is, the riskiness for that particular borrower rises. So again, that can be a downgrade risk. Now, downgrade risk is something which is applicable for the exposure management as well, not just for loans, but whenever we have any kind of derivative positions which might have been taken with certain counterparties. Now, any kind of downgrade in the credit rating of those respective counterparties will attract more amount of capital charge. So we'll talk a bit about the capital charge framework in our subsequent videos. We'll touch upon them briefly as a part of this discussion. Then one of the examples of credit risk which we had observed globally was the Greek debt crisis, which had happened around 2012-2013. So the problem which had happened with the Greek debt was, and the Greece government had raised significant amount of debt capital by issuance of bonds, which were backed by the full faith of the Greek government. And the primary holders of these bonds were mainly banks which were situated in Europe. So, firstly, Greek banks, along with that, even German and French banks had significant amount of exposure to the Greek debt. Now, when the time came for repayment of debt, the Greek government did not have ample amount of funds in order to make the required payments. So that's why they had to approach the ECB in order to rescue them. So what the ECB did was they allowed them to change. Now, they naturally could not allow the Greek government to default because the thing is, we are talking of the Eurozone or the Euro bloc. And in case they allow one of the countries to default, that will naturally expose other countries to a significant amount of loss, something which any regulator will not want. So ECB came to their rescue, and finally, Greek government was able to get out of this mess. So this was one of the examples of credit risk, or credit crisis on a macro level. So this was at a macro level. Now, even at micro level, bank is exposed to various types of credit risk, as we mentioned, depending on the individual borrowers or individual entities whom they deal with. Again, they are exposed to some bit of credit risk. So that happens at a micro level. But be it macro or micro, credit risk is something which every lending institution like a bank is exposed to. Now we know that the core business of the bank is taking on credit risk. So even the bank's management appreciates that, and they know that in order to function as a bank, some amount of credit risk has to be taken. Now, the degree to which the credit risk has to be taken is something which depends on the overall risk tolerance or risk appetite for banks. Now, we had discussed a bit on risk tolerance or risk threshold as a part of our earlier videos. So the same principle applies here. So the board generally approves a certain level of risk tolerance or a risk threshold, something which the bank is expected to follow. And that basically regulates the amount of risk which a bank is willing to take. So even credit risk is something which we try to study through the same policy which has been approved by the board. So that puts a certain limit up to the maximum amount of business risk which a bank can take. Now, understanding the origins of credit risk, and subsequently we'll talk a bit about the mitigants which banks popularly use. So from a bank's perspective, there are two main sources to which a bank will be exposed to whenever we talk from a credit risk perspective. One is the loan book, or what we call as the banking book. So popular name for loan book is a banking book as well. So that the probability of borrowers defaulting, that is the kind of risk which a bank is exposed to from a banking book perspective. So this happens to be one of the sources of credit risk. And there can be derivative positions. So generally, derivative positions are booked as a part of the trading book. Now, the concept of exposure monitoring is something which is very important whenever it comes to monitoring of derivative positions. And globally, banks are expected to calculate exposures on a day-to-day basis. So that is like a regulatory requirement which every bank has to follow. And this is another measure of the credit risk which a bank is exposed to, because exposure defines how much amount of risk which we are carrying because we have transacted with a certain counterparty. So imagine I have an exposure of X dollars with a certain counterparty ABC. That implies that that much is the amount of funds at risk in case XYZ defaults. So that is a simple way of understanding exposures to counterparties, and that is another source of credit risk. So naturally, banks are expected to take certain mitigations or certain mitigants in order to manage this kind of credit risk on their books. So a few popular techniques which banks use for mitigation purposes is estimation of collateral amount demanded from customers. When we talk of collateral, this collateral can either be a cash or a cash-like collateral. Cash or cash-like. So cash is easy. So uh, these are actual funds which are deposited as a part of the collateral. So in case the customer defaults, then the bank can simply utilize the collateral in order to make up the credit loss which it is exposed to. Other is a cash-like collateral. So a cash-like collateral is mainly comprising of treasury securities. Now, why we say treasury securities are cash-like? Because we know that treasury securities are default free. We do not expect the government to default on their commitments. So imagine that I am parking uh, a US government treasuries as a part of collateral. Now they are cash-like because I don't expect the United States government to default on their commitments. And in case I have to offload those securities, I do not expect to take too much of a price hit because they are liquid enough and the demand for those securities is pretty good. So that way, there's not much of a liquidity risk as well, which I'm exposed to. So that's why whenever we say cash-like products, these are generally treasury securities. Next is capital adequacy. So we can relate capital adequacy with the concept of capital charges. So we know that the Basel Committee of Banking Supervision, or BCBS as we call it, they have come up with specific guidelines as to how a bank can calculate capital charge. Now, the main idea behind capital charge is to ensure that bank has ample amount of capital put aside because they're adding risk onto their books, especially true whenever it comes to let's say your trading positions, because they can be very risky depending on the kind of portfolio which a bank holds. So the idea which regulators try to explain through capital adequacy is they say that banks can add on risk onto their books. However, we expect banks to allocate a commensurate amount of capital in order to counter any kind of credit risk which they are exposed to because of these transactions. So, depending on the amount of the portfolio positions which are adding risk onto the book, the bank is expected to put aside a certain amount of capital, which we call as regulatory capital. So, we'll talk a bit about regulatory and economic capital in the subsequent slides of this video. But this is the main reason behind requirement for capital charge. Next is CVA or credit value adjustment. Now, the main idea behind credit value adjustment is to take into consideration the credit transition or the potential downgrade risk which a bank is exposed to owing to the ratings of its counterparties deteriorating. Now, whenever imagine I have a bank, and if I am transacting with a certain number of counterparties, then I do not expect that I'll have a government at the other end all the time. That is, my counterparty may not be the government every time, or there'll be seldom cases when the government is the counterparty. Majority of the time, these are going to be private entities, and I don't expect every private entity whom I transact with to have a rating of AAA or to be the safest ones. There may be certain lower rated counterparties as well whom I am transacting with. Now, whenever we talk from a CVA perspective or a credit value adjustment, we are looking at the potential credit transition risk which I am exposed to. Because whenever the rating of my counterparty drops, that naturally implies that the kind of credit risk which I am carrying on my books is rising. Because whenever a credit rating drops, let's say my counterparty at the start of the trade was rated AAA, and imagine that 2 years down the line, while the trade is still alive, this rating drops to A. Then that means the credit worthiness of my counterparty has deteriorated. So I need to figure out some way to allocate additional amount of capital uh, because I may be exposed to potential credit defaults because of the downgrade of my counterparty. So CVA is the answer to that question. So CVA will tell me how much amount of additional capital I need to put aside because my counterparty's ratings has dropped from AAA to A. Now here we have taken an example of just one counterparty. But from a practical perspective, a bank's portfolio is large and you'll have n number of counterparties whom you will be transacting with. So for every transaction, we are expected to calculate a required amount of CVA capital charge required. And finally, we arrive at a CVA capital charge number, which will be an enterprise-wide or a bank-wide number. This will help the bank estimate what is the kind of capital charge expected from the credit transition risk which is exposed to. Also, additionally, new accounting rules like IFRS 9, they also play an important role in mitigation of credit risk because they require estimation of what could be loan losses at the outset of the loan. So at the time the loan has been sanctioned, they are expected to give an estimation of what could be the potential loan losses. So we'll talk a bit about loan losses in a subsequent part of this video. There we'll discuss more about these things because these are very important from the overall risk framework for a bank. Now, from a regulatory perspective, authorities use a 1 year time horizon to cover potential losses from credit risk. So remember this for the exam. On the exam, it may be asked that what is the time horizon which the regulatory authorities look at whenever they are looking at a certain type of risk. So for market as well as operational risk, we'll talk about this time horizon. But for credit risk, remember the time horizon is 1 year. Now coming on to market risk. So market risk is defined as the potential uh, or the potential loss or MTM losses which a bank will be exposed to because of the movement of various risk factors in the market. Now, whenever we say risk factors, these are technical. This is a technical name which is given to various market parameters or market inputs. So, a few risk factors or parameters can be interest rates, FX, equity prices, commodity prices, etc. Now, any kind of fluctuations in these RFs or risk factors is going to expose my portfolio to certain MTM price movements. Naturally, isn't it? Because whenever I am pricing my portfolio, in order to understand how much my portfolio is worth today, the movement in these risk factors are going to govern how much that MTM fluctuation is going to be. So any kind of losses which the bank will be exposed to because of the fluctuations in these risk factors is what we call as market risk in a nutshell. Now, depending on the kind of portfolio which I hold, I will be exposed to different kinds of risk factors. So imagine that I am holding just a plain treasury securities portfolio. Then the only risk which I will be exposed to is the interest rate risk. Now, let's say my front office tomorrow decides that they want to start transacting FX options. Imagine up till yesterday, we did not have FX options. Then from tomorrow, I need to take into consideration the FX risk as well, because that is an additional risk which I'll be exposed to. Let's say the next week the front office decides that we want to venture out into equities. So a movement in equity prices is something which is going to impact the risk of my portfolio. So again, equity is another risk factor which I'll be exposed to, and so on. So this is how the new asset classes which my bank starts transacting in, the I'll be exposed to more amount of risk factors, something which I'll have to factor in as a part of my market risk calculations. Now, especially from a trading book perspective, calculation of market risk is very, very important because our trading book can have various types of products. It could have fixed income, derivatives like swaps, options. We could have an active FX desk whereby they are using FX swaps, FX forwards, or there could be an equity derivatives desk, fixed income desk, etc. Now, we know that all of these asset classes will be exposed to the respective risk factors. And the movement in these risk factors are going to impact the level of market risk which I am carrying. So, market risk is something which becomes very relevant whenever we are trying to understand what is the risk of our trading book. And just to recap, every bank's portfolio gets divided into a banking book and a trading book. And as we had discussed in our earlier videos, banking book products are uh, things like loans, overdrafts, etc. Whereas trading book assets could be anything which comes from your trading activities. So it could be swaps, or it could be equities, or it could be FX, it could be options, etc. All of these get classified as a trading book. And and these are going to add a risk which we try to understand through the market risk framework. Now, many a times a bank may also act as a market maker. So we know that by definition, a market maker is that particular entity in the market who is going to continuously post buy and sell quotes to the market, and and the main idea behind market making is to ensure that ample amount of liquidity is provided for market participants for any specific asset class. So if a bank or certain set of dealers in the bank are acting as a market maker, naturally they will be exposed to some bit of market risk because they will be quoting bid and ask spreads, and they will be expected to take positions in case a certain counterparty wants to trade. And this is something which can add a market risk onto the bank's book. Now, from a regulatory point of view, the time horizon is less than 1 year to cover potential losses from market risk. Again, an important thing to remember from an examination perspective. So, from a regulatory perspective, the time horizon considered is less than 1 year in order to cover potential losses from market risk. Next comes operational risk. So when we study operational risks, generally these are the type of risks which are classified as low probability and high impact type of risks. So we'll try and understand operational risk through a few examples, which will bring more clarity to this concept. So a brief classification of how we can divide an operational risk is risk which arises because of insufficient or inadequate internal processes or people's practices, which a certain bank may follow, and any kind of loss from external risks which a bank is exposed to. So these are the broad subcategories in which we study operational risk. Now let's try to look at it through a few examples to understand this better. So from an internal perspective, internal frauds can be one of the main risks which a bank gets exposed to. And one of that example is rogue trading. So there are multiple instances whereby global banks have been exposed to losses owing to certain traders who go rogue. So one of the popular examples was Morgan Stanley, which was exposed to $1 billion of losses because of the London whale episode, which had happened a few years back. So that's when a trader decides to transact on their own accounts. The idea is whenever a trader starts transacting on their own accounts, they basically look at generating P&L for themselves and not really for a bank. And that's not expected, isn't it? Because they are a part of the bank and they're expected to utilize their expertise and skills for the benefit of the bank and its clients and not for themselves. However, examples like Morgan Stanley's, London Whale, or even Barings Bank, etc., all of these are examples where rogue trading exposed banks to significant amount of losses owing to insufficient internal controls. Now, we call this as insufficient internal controls because there has to be a proper framework or a proper structure which a bank follows whenever it comes to management of such risk, operational risk points. And one of the examples can be bifurcating between the way in which traders or any people who are active on the business front can access other systems in the bank. So things like managing read and write access for the system, that is something which can regulate these kind of activities. That is, someone who is booking a trade should not be given an opportunity for reconciliation of the trades as well, or reconciliation in the backend. Because if they are given an entire access to the workflow, that implies they can book any fictitious trades in any fictitious accounts. And significantly and subsequently, anyways, if they'll be handling the back office reconciliation as well, then they can make the required tweaks in order to hide that thing. So again, that is something which is not acceptable, and this is what we call as the risk from an internal fraud. Next can be external risks. So cyber attack risks are something which every bank is very, very careful about. These are important because cyber attacks have a potential to damage a bank system significantly. And a few reasons as to why banks are very careful about this is because we know that bank has a significant amount of data which it has on its servers. And in case of a cyber attack, there could be a chance that there could be a data loss or data theft, which won't be acceptable from a bank's perspective. So cyber attacks also include ransomware risks. That is, a bank gets exposed to, let's say, a bank system gets hacked by a certain group of hackers or a single hacker, and a hacker demands a hefty ransom. Now, now that's a significant operational risk, isn't it? Because if the bank system gets frozen, then the bank will have no other choice but to find out a way out of that mess. So bank has a significant amount of IT security infrastructure which is in place in order to protect itself and its customers from any potential cyber attack risks. Then activities from clients or business processes. So there can be certain fraudulent or illegal activities by bank's clients. So that's also possible. So ways to tackle this are guidelines around AML or CFT. So the idea behind these guidelines is to ensure that any kind of fraudulent activities are tracked and they're stopped then and there itself. We do not we do not want bank to get entangled in any kind of uh, money laundering instances which might happen potentially in the future. So banks are very, very careful whenever it comes to processes like KYCs and maintaining their AML infrastructure, and also ensuring that the funding does not come from any illegal sources. Especially, banks are very careful that those kinds of funds do not get diverted for any illegal activities as well. Because many a times, as a part of AML and CFT, what we observe is the source of funds is illegal, and and the people who are engaged in these activities, they try to use the banking channels in order to make these funds legal in nature, which is a completely fraudulent and illegal activity which the banks do not permit. And banks need to have ample amount of AML and CFT infrastructure in order to prevent such instances. Next is natural calamities. Now, natural calamities, as we know, is something beyond anyone's control. Now, let's say an earthquake, or maybe something like a COVID pandemic, which hit us recently. Now, all of these points are COVID may not be a exactly natural calamity, but again, that was a important and that was a very important global event because that impacted every industry, including banking. Other examples of natural calamities can be famines or floods, earthquakes, etc., or even hurricanes, storms, which can have a devastating effect on various geographies. So again, these are the kind of things which can increase the operational risk. So this is where the robustness of things like BCP, which we call as business continuity planning, gets tested, because every bank needs to have a certain robust BCP infrastructure in order to manage such kind of risks which are coming out from natural calamities, in order to ensure that business continuity happens. So BCP failure. So this is the next point as well. So in case your BCP process is not robust enough, then the bank would finally see that those kind of Now, those kind of process which it had relied on in case of handling such natural calamities, it's not able to function well. So, if a BCP infrastructure fails, that can have a long-term impact on the bank, because that way it is going to hamper all of the activities which a bank does. Now, the example was COVID-19 pandemic. So during COVID-19 pandemic, most of the work had moved online. We didn't see any employees who came to offices in the initial weeks of the pandemic when it was very, very risky and infectious. So at that time, most of the activities which were happening from the respective homes of the employees, because employees were advised to stay at home and work from home. So work from home was one of the examples whereby the BCP infrastructure was tested. Now, those banks who were at the forefront of adopting technology in order to support the BCP type of applications, those thrived. So that's how important a BCP process is. And also we need some way to or some way to figure out, or some way to manage the process errors or manual errors which can happen. So one of the examples is the fat finger error. So imagine that there is a significant amount of manual intervention which is expected as a part of a day-to-day activity. So let's say there is an analyst who comes into the bank every day at 9 a.m. And the first thing which that analyst needs to do is he or she has to enter or punch in 100 numbers into an Excel spreadsheet. Now, this is a significant amount of human intervention, isn't it? So they may read the numbers from somewhere and then they would have to punch it inside a certain Excel sheet. So at that time, there is a chance that a certain error, which we call as a fat finger error, can happen. So an example of fat finger error can be the actual source data might read the data as 49, whereas when the person is actually punching in the data into the Excel, they may punch in as 94. So this is what we call as a fat finger error. Now, in order to reduce these kind of process errors or inadvertent human errors, we try to use as much amount of automation as possible. So as a part of operational risk infrastructure, every bank will try to automate as much amount of activities as possible, because whenever we have a certain machine who is doing a certain activity, naturally the probability of making an error reduces, or it gets almost eliminated. So that is another risk which a bank addresses through the operational risk framework. Now, operational risks are increasing over time because the gamut of activities which the bank is doing is also increasing as the banks rises. As the bank's business size rise, they are going to be exposed to more and more amount of operational risk. So they require a robust operational risk infrastructure in order to manage such risks. Further, from a risk modeling perspective, it is important to have a good understanding of the way in which market credit and ops risk interact with respect to each other. So although we study them separately, finally, as a part of the bank, all of these risks have to be seen together, because we know that whenever we are talking from a risk management perspective for a bank, we have to take into consideration how much amount of risk a bank is exposed to at an enterprise-wide level. Because no one is, so even when you talk from a regulatory perspective, regulator will not will not tell the bank that you have a breach on only one type of risk. If you're talking from a regulatory perspective, if there is a breach, the regulator says that it's a regulatory breach, and that's like, and the bank can't say that our market risk team has made. I mean, they did not monitor the market risk exposure, so there was a breach. That's not an acceptable answer. So finally, everything what happens at the bank wide level or at an enterprise wide level. So from risk modeling perspective, it is very, very important to understand the interrelationships between different types of risk so that we are able to build a very robust risk infrastructure which can handle any kind of stresses which build in the system over time, and which do not pose any kind of risk from regulatory standpoint as well. Now, risk managers need to study the joint probability distributions. Now, this is a related point. Whenever I say that we are talking of interrelationships, the technical term to say that is the joint probability distribution. So when we say the joint probability distribution, something which we have discussed as a part of the quantitative methods videos as well. So a joint probability distribution basically talks about the correlation between different types of risks. And these risks are not independent of each other. There is some degree of correlation which is always there. So a movement in one type of risk has a potential impact on another type of risk as well. So that is something which we try and understand through joint probability distributions. So maybe one of the examples to understand that correlation can be, let's say a bank has taken a certain position or a certain equity investment in a certain company. And imagine that the equity share price is rising. So maybe let's say the market is upbeat about the company uh, for some reason, and the company's share price is rising. So the bank would see the size or the or the overall MTM of their equity portfolio rising, which can be a plus sign. However, at the same time, it can happen that that particular company whose share price is rising also happens to be a customer or the borrower for the bank. And the bank has observed that in the recent times, they have gradually defaulted on a few commitments or the repayment commitments which were due to the bank. So, so now here we see there is an interrelationship, isn't it? On one side, we see that the share prices are rising, and on the other side, we know that that particular company, which was a bank's borrower, has defaulted on a certain payment commitments or its payment or loan payment commitments which were due. So that way, bank needs to consider the joint movements here. It simply cannot be happy that fine. I mean, their equity share prices are rising, so they're happy. They have to be equally careful about the credit portfolio as well, because if the customer defaults, that can have certain large scale implications or large scale losses of which their banking book might be hit with. So this is just one example. Similar to this, there will be other instances as well whereby the role of correlations or interrelationship between various types of risks has to be studied correctly in order to ensure that the risk management at an enterprise level happens very effectively.